US market Basel III compliance on July the 1st will have as dramatic an effect on the gold price as when the FX gold market was brought into compliance on the 1st of January 2023. So in order to comply, the audit will have to be concluded well before the July compliance date. Now in sync with what our liquidity providers say, we project it will ultimately cost an extra 3,000 to buy the same ounces of gold, forecasting a minimum of 3,300 gold price by the end of the second quarter. That's very conservative. And a realistic 3,500 by the end of the fourth quarter. Then we're looking at very large moves higher.
The upcoming U.S. Basel III compliance on July 1st is expected to significantly impact gold prices, similar to the FX gold market compliance in early 2023. To meet these regulations, an audit must be completed beforehand, forcing gold market prices to reflect actual supply and demand. As a result, gold is projected to rise sharply, with a conservative target of $3,300 by the end of Q2 and a realistic estimate of $3,500 by Q4. These targets suggest even larger price movements ahead as market adjustments take effect. Andrew Maguire, a seasoned precious metals expert, explains that the race to short cover ahead of the July 1st Basel III compliance deadline highlights the growing physical gold shortages and the failure of paper markets to suppress prices. Central banks and sovereign buyers, particularly China, continue accumulating physical gold, forcing a structural shift where leveraged COMEX positions are converted into accurate delivery. The Fed's urgent gold repatriation efforts, triggered by Trump's policies, have further exposed the gap between paper and physical gold prices, driving demand higher. As physical shortages persist, short selling has become increasingly risky, with expanding EFP spreads signaling the higher cost of closing unbacked paper positions. Recent news reveals that the Arger-Heraeus refinery in Switzerland has been operating around the clock to meet the unprecedented demand for 1 kilogram gold bars in New York. This surge is driven by fears of potential U.S. tariffs on gold imports, leading to logistical challenges and bottlenecks at institutions like the Bank of England's gold vaults. We present the clips of Andrew's latest video. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Ahead of the 1st of July Basel III compliance. It's a big deal. Let's start by looking at the larger picture then. Then we'll look at the end of the quarter footprints. And based on what we are once again seeing in the tight for supply physical markets, then we'll have some projections for the end of the next 3 quarters into 2026. It's not about the Fed or tariffs. We're privileged to be witnessing the early stages of a gold price revaluation, which is an ongoing process, not a single event. We're witnessing it. We're privileged to see this historic thing unfold. However, there will be some inflection points, which we will, as we witnessed, and they're bullish ones, as we witnessed when the Shanghai Futures Exchange launched at $2,000 back in March last year. And now a similar bullish driver is the run-up to the 1st of July. And we'll look at that a bit closer in a little while. But all our projections have relied upon where central bank sovereign buy interest is, and it's been steadily stair-stepping higher. It's now become impossible for fund managers to ignore gold, gold has outperformed every single other asset class. And this huge untapped source of investment flows have yet to come into gold, and they're only just waking up to it. And I think Peter Grandage said the average fund manager has maybe 0.5% exposure to gold. That's interesting. So this fresh incoming investment demand into already tight supply indicates 3,000 gold is massively underpriced. So let's take a look at the footprints and where they're ultimately headed and why. And as we summed up in our last episode, into stretched out physical gold delivery timelines, which are delivery defaults by no other name, an increasing percentage of leveraged COMEX paper market gold longs, they're fully paying up their COMEX positions to force physical delivery. Now, we call this the sticky open interest component, which is the fund managers who are buying it for a reason, for the right reasons. But it's also forcing large COMEX outflows into the exchange traded funds, compounded by physical buyers targeting the COMEX backdoor EFP mechanism, the backdoor EFP mechanism, which is the Achilles heel, that then forces a non-compliant, a non-Basel III compliant paper price. If it lands in London on a T+1 delivery basis in a compliant market, and what was previously cash settled comes into full physical settlement into this Basel III compliant local London market. Trump's tariff mandate that really caught the Fed flat-footed, and the sudden race to repatriate paper gold positions into safe haven first-tier gold exposed the inelasticity of the available physical bullion at current prices, meaning there just isn't enough bullion at current prices, meaning that it has to be bought back at higher and higher prices. Now, we previously posted the link and took apart the LBMA video. You remember this video that the LBMA came out, and they were saying, oh, yes, the idea, 8 to 10 week refiner delays for COMEX compliant 100-ounce bars. They're just related to COMEX exchange, and, really trying to spin it as, no, there are no real shortages. That backfired. And it drawing really unwanted attention into the real extent of the global supply shortages at current prices. And despite allowable double accounting rules, making the true extent of the supply problems, hiding them, it's been the failure to physically load out the 400-ounce standard bars from the Bank of England LBMA vaults into a Basel III NSFR T+1 delivery protocol. It's that it hasn't moved that's really exposed the true scale of these delivery defaults. Now, we've previously drawn attention to the largely ignored it's called the GC4 enhanced delivery contract. We spent some time looking at it, which enables a local London 400-ounce bar to remain in the London vaults without physically moving to the US vaults, so yet it's counted as there. Now, these flows also synthetically assist in closing the EFP spread, i.e. the spread between the paper price and the physical price. As an example, we witnessed this into an attempt to block central bank buy stops at spot 3,000 from getting tripped off last Friday the 14th. We knew that Asia would come in and take it, and sure enough, they did. Now, these failures to deliver have not gone unnoticed by competing central banks who have doubled down on targeting and locking in COMEX registered inventory for delivery, alongside locking in exchange for physicals at the AM and PM fixes for Basel III compliant market delivery. So in other words, central banks and sovereigns and the large buyers need a fix. So you might intraday it be higher and lower, but usually it requires an actual fix to mark that to market. So a large size to market. Into all of this maelstrom of bullish inputs, the Fed trying to prioritize 400-ounce bullion repatriations ahead of an upcoming US Treasury gold audit is something that would never have happened had Trump not taken the helm. Now, these repatriation efforts have made it very risky to short sell paper gold into such large physical demand. And it's what has driven the unnaturally widened EFP spreads, the paper spread to paper to physical spread. And in other words, the paper price being so much higher than the physical price. And it was gapping to levels not experienced since the 2020 COVID refinery lockdowns. And the EFP spreads simply represent the higher cost to close out an unbacked paper bet against global facing deliverable gold and silver. And I should add that while the Fed employs agent bullion banks to do their heavy lifting, every single bullion bank, without exception, is actually long bullion for their own books, i.e. they act as an agent. But this is where it gets really interesting.
The impending Basel III compliance deadline accelerates a fundamental shift in the gold market, where physical demand overpowers paper manipulation. With central banks prioritizing actual gold holdings and supply constraints becoming more evident, prices are set to climb significantly. The coming months will determine how high gold can go as market forces fully adjust. How might central banks' continued gold accumulation influence global monetary policies in the long run? What role will the U.S. Treasury gold audit play in shaping gold market dynamics post-Basel III compliance? Share your feedback in the comments below. If you found this helpful video, hit the thumbs up and subscribe to keep up with our latest updates. We appreciate you being a part of this journey.